We are focusing on Section 1031 like-kind exchanges, a heavily tested topic on the enrolled agent exam. The most critical point to remember, and a common exam question, is that since the Tax Cuts and Jobs Act, Section 1031 treatment is only available for exchanges of real property. Personal property, such as vehicles, equipment, or collectibles, no longer qualifies for this tax deferral. The exam will try to trick you with scenarios involving the exchange of business trucks or machinery. Remember that any gain on those exchanges is now fully taxable. For a 1031 exchange to be valid, the property being exchanged must be held for productive use in a trade or business or for investment, and it must be exchanged for like-kind property that will also be held for productive use in a trade or business or for investment. For real property, the term like-kind is very broad. An office building can be exchanged for raw land or a rental house for a retail center. The location in the U.S. doesn't matter, but U.S. real property cannot be exchanged for foreign real property. The timelines involved are a primary source of exam questions. You have 45 days from the date you transfer your relinquished property to identify potential replacement properties. This identification must be in writing and delivered to a qualified intermediary. Following that, you have 180 days from the date of the original transfer to actually receive the replacement property. Here is the trap. The exchange period ends on the earlier of 180 days or the due date, including extensions, of your tax return for the year of the exchange. For example, if you sell your property on December 1, 2023, your 180-day period ends May 30, 2024. However, your tax return is due April 15, 2024. If you do not file an extension, you must complete the exchange by April 15, not May 30th. Expect a question testing this specific nuance. To remember the timelines, use this phrase, 45 to identify, 180 to buy. Another non-negotiable rule is the use of a qualified intermediary or QI. You, the taxpayer, cannot have actual or constructive receipt of the sale proceeds from your original property. The funds must be held by the QI, who then uses them to purchase the replacement property on your behalf. If the money hits your bank account, even for a moment, the exchange is disqualified and the entire gain is taxable. Now let's talk about boot, which is where most calculation questions come from. Boot is any non-like-kind property received in the exchange, most commonly cash or relief from debt. When boot is received, you must recognize gain, but only up to the amount of boot. The rule is you recognize the lesser of the gain you realized or the boot you received. For example, imagine you exchange a building with a fair market value of $800,000 and an adjusted basis of $500,000. Your realized gain is $300,000. You exchange it for a new building worth $750,000 and you also receive $50,000 in cash. The cash is boot. You must recognize a gain of $50,000 because it is the lesser of the realized gain, $300,000, and the boot received, $50,000. The remaining $250,000 of gain is deferred. Remember that mortgage relief is also boot. If the mortgage on your new property is less than the mortgage on your old property, that difference is boot. And critically, losses are never recognized in a Section 1031 exchange, even if boot is involved. Finally, be aware of related party transactions. If you conduct a 1031 exchange with a related party, both you and the related party must hold the respective properties for at least 2 years after the exchange. If either party disposes of their property within that 2-year window, the original deferred gain must be recognized in the year of that disposition. All of these transactions are reported on Form 8824, like-kind exchanges.